For most Americans, taking out a mortgage makes buying a home possible. But how do you get a mortgage? This guide breaks down the mortgage process so you'll know what to expect when you apply for a home loan. How to get a mortgage. Step 1. Strengthen your credit. The best loan offers go to borrowers with credit scores in the 700s. That's because a strong score demonstrates you can responsibly manage your debt. Having a strong credit history and credit score is important because it means you can qualify for favorable rates and terms when applying for a loan, says Rod Griffin, Senior Director of Public Education and Advocacy for Experian, one of the 3 major credit reporting agencies. If your credit score is on the lower side, you could still get a loan, but you'll likely pay a higher interest rate. To improve your credit before applying for your mortgage, Griffin recommends these tips. Make all payments on time and reduce your credit card balances. Your payment history on your report goes back 2 years or longer, so start now if you can. Bring any past due accounts current. Past due accounts will sink your score. Bringing all of these accounts current and continuing to pay them on time can limit some of the damage. Review your credit reports. You can check your credit reports weekly for free at annualcreditreport.com. Check for errors on your credit reports, and contact the reporting bureau immediately if you spot any. For example, an error might be a paid-off loan that hasn't been recorded as such, or an incorrect address. Check your credit score, check your reports, and score well before applying for a mortgage. When you review your score, you'll see a list of the top factors impacting it, which can tell you what changes to make to get your credit in shape, if needed. Step 2. Know what you can afford. One way to determine how much house you can afford is to figure out your debt-to-income (DTI) ratio. The DTI ratio is calculated by summing up all of your monthly debt payments and dividing that figure by your gross monthly income. The lower your DTI ratio, the more room you'll have in your budget for expenses not related to your home. That's why Andrea Warwick, a Bakersfield, California-based personal finance and budgeting authority, says it's essential to take into account all your monthly expenses and your set-asides for far-off plans. The last thing you want to do is get locked into a mortgage payment that limits your lifestyle flexibility and keeps you from accomplishing your goals, says Warwick, a condition known as house poor. You can determine how much house you can afford by using Bankrate's calculator, which factors in your income, monthly obligations, estimated down payment, and other details of your mortgage.